What is a stochastic oscillator and how best can you add it to your trading? This is a momentum indicator that is used to identify overbought and oversold prices that is similar to RSI indicator but has way stronger probability. Therefore, it's one thing that maybe you can add to your trading. If you're new to the Exploit family, welcome. I am Wanjuru Gishang, and on this session, I'll be taking you through an awesome video on how to add the stochastic oscillator into your trading journey. So how do you set up your oscillator or your stochastic oscillator on your chart? So you just go to your chart. You can use either a trading template, a chart that has a trading template, or just a naked chart. Then you go to Insert, click on Indicators, go to Oscillator and choose your stochastic oscillator. Now, just for the beginners, any indicator that has the name oscillator basically means it's an independent indicator. What we mean by that is it will not show inside your chart where the candlesticks are. No. Once you insert it, it's going to show at the bottom of your chart independently. Why does that happen? Because an oscillator basically mirrors the market. Okay, mirrors the candlesticks. And that's why you can actually use an oscillator on its own, even without looking at the candlestick. Now, examples of oscillators, this can be the TDI, you see them all here. You have bear powers, commodity, you have the RSI, and also the TDI, okay, which is a customized indicator. Now, if you've not watched the RSI video that I did with divergence, this is actually a stepping stone from there. So it's important that you watch the RSI with divergence video so that you may understand this video. I'll be referring to the RSI and divergence video in this video frequently. So it's important that you have that foundational video. Also, you may watch the TDI, the Traders Dynamic video. It's also going to give you more information to build on. So you click on Insert, Indicators, Oscillator, pick your stochastic. Now you can just have it on default form. You do not need to change anything unless you want to do that. The stochastic oscillator has the blue line and the orange line. If you're going to trend it independently, that is, you're going to use the crossover strategy that we're going to mention in a few, then you're just going to pay attention to this. So if the market is pushing down, the orange line will show up on the top, okay? And if the market is pushing up, the blue line will be at the top. So it's to check how they interact. Is the blue line at the top? If that is so, then the market is pushing up. If the orange line is at the top, then the market is pushing down. Now, the stochastic oscillator also has levels. At the far right side, you see there are levels. It has 100, 80, 20, and 0. If the market gets to the 80 level, it means that the asset is overbought or it's very expensive. And therefore, there are chances that this asset will change or they will start selling or it will be pushing down. The same, we have the level 20. When you're on the level 20, it means that the asset has been oversold and therefore the market has higher probability that it's going to start buying. So you can use this oscillator independently by using the crossover strategy. Just checking when it crosses over and when it's on these key levels. But that is not what we will be dealing with today. We want to take it to the advanced level. But in case you want to trade the crossover, you can just watch the RSI video and whatever steps we've given, you just apply them but using the stochastic indicator. So if the market is on an uptrend, we have mentioned that if the market is on an uptrend, you're going to find that the blue line will be at the top while the orange line will be at the bottom. So you may use your stochastic indicator for buyers or for what we refer to as market analysis. You want to know the direction of the market. So if you just check on your oscillator, then you will know the direction of the market. So if the blue line, and remember this should be done on the higher time frame. If you're doing market analysis, it should be on the higher time frame. So we are talking about the 4-hour chart and above, nothing below this. That is for direction. So if the blue line is at the top and the orange line is at the bottom and you're looking for direction, then that is an uptrend. The other side, if it's on the downtrend, then you find that the orange line will be at the top while the blue line will be at the bottom. So these you know that you are on a downtrend. Now, what are the uses? What are the different uses that you can use your stochastic oscillator on? So what are some of the uses of the stochastic oscillator? Some of these uses you can use when you're doing your trade entry. We've talked about when you want to do your market analysis, you check where the blue line is. If it's at the top, then that's an uptrend. If it's at the bottom, that's a downtrend. But if you want to trade, you're on the trading, you can use it using the crossover strategy. I've discussed the crossover strategy, the RSI and divergence video, so you can always check the details on the crossover there. But when you're using this oscillator, basically what you want to see is if you're going to take a buy trade, you want to have this crossover happening. When using the crossover strategy, you want to go to a higher time frame and check the trend. Once you've checked the trend, if the blue line is at the top, you know that the market is on an uptrend. Therefore, then you're going to go to a lower time frame, and wait for the crossover of the two lines. If the blue comes at the top and it's on the 20 level, very, very important. It has to be on the 20 key level or below, 20 or below. And you can see this is happening below the 20. So here now you can go to your lower time frame, look at the candlestick. Remember, it's always important when you're trading using an indicator, it's important to also pay attention to the candlesticks. So the crossover has happened. It's also important to check the candlesticks that are forming. And you can see here we are having the cut of wood, and the cut of wood is a very good entry pattern. So the presence of this cut of wood and the crossover here shows a very good entry, and therefore you can take that buy trade. Now note that I'm on the higher time frame, so when you go to the lower time frame, of course the move is going to be very massive. Now that is how you use the crossover to the buy side. Suppose you're looking for a sell setup. For a sell setup, again, you need to go to the higher time frame and make sure that you're on a downtrend. Why is that important? Because it gives you high value trade setup. You're not just counter trading. I know there are traders who make it or make a living out of counter trading. It's also good. It's a good trading way, but that it's an advanced way of trading. If you're a beginner or you're still growing your account, it's always good to make the trend or the cycle your friend. So first things first, go to the higher time frame and check the presence of at the trend to the downside. I've already said you can still use the same oscillator to check if you're pushing down or not. Alternatively, you can learn how to use trend lines. We have a video on trend lines, therefore just use it and see if the market is pushing up or down. Now, once you know that the trend is down, now go to a lower time frame of your choice and check if the market is on the 80 level or above. Very, very important, 80 level or above. And here you see that the market is way above the 80 level. That is step number. Step number. Now wait for the crossover. You got to be really, really patient. Wait for the crossover. This is when the orange now dominates. The orange comes above the blue line. That is step number 3. Step number 4. Now pay attention. Pay attention to your candlesticks. Very, very important. Pay attention to your candlestick. You want to see now the dominance of the sell side. You want to see the dominance of the sell side. And I hope that you've read book 7 on technical trading, where you learn about dominance. So from here, you can see that you can take that trade down until there is a crossover to the other side and you leave that trade. So that is how to use the crossover strategy in 4 steps when you're using the stochastic oscillator. Remember, step number 1 is go to the higher time frame. Make sure that you're on a specific trend. Then number 2, go to the lower time frame and check if your oscillator, if the market is on the level, either level 20 for buying or level 80 for selling. Then step number 3 is to wait for crossover between the two lines on the stochastic oscillator. If the crossover is to the top, the blue line should be at the top, and that's a signal for buying. If the orange line is at the top, then that's a signal for selling. You want to see a candlestick pattern, you want to see dominance on the participants. If it's sellers, you want to see dominance in selling. If it's buying, you want to see dominance in buying. So in those few steps, that is how you can use the crossover strategy. Use number 2 of how you can use your stochastic indicator for entries is by using divergence. Now, we've done a very, very elaborate video on divergence. That is the RSI and divergence video. It has the different types of divergences and how to use it. Just to mention, just in case you've not gone through that video, there are different types of divergences. We have the regular divergence that we use for reversals. And we also have the hidden divergence that we use for continuation trade setup. So I would suggest that you pause this video or make a note for you to watch the divergence video so that you're able to understand the different types of divergences that we have and how to use them. Now, how do you use stochastic oscillator and the divergence? Note, when using divergence, you want to see difference between presentation. The chart is presenting the market to the top while the oscillator is giving a different presentation. That is basically what divergence is. So on an uptrend, this is what you do. On an uptrend, you're going to go to your chart on a higher time frame. You're going to identify an uptrend. So the market is pushing up. And when the market is pushing up, it's creating a series of higher highs. Now, if you don't know how to identify the uptrend, there is the market structure video. It has details on that. Now, you get to a certain point and you see loss of momentum. This is step number 2. So step number 1 is to identify an uptrend. Step number 2 is to identify loss of momentum. Now, how do you check loss of momentum? You learn that from book number 7. I've explained the different types of momentum and momentum loss. So here, in a nutshell, you can see that there's no much dominance from either side though. So this is a sign of loss of momentum. Then number 3, you're going to look for divergence on the chart and on the oscillator. Now check, we had this higher high, then we had loss of momentum, but the market pushed really strong and created a higher high. So we have this high and we have a higher high. But on our oscillator, what happened? We have this higher high here. And then instead of creating a higher high like our chart, it created a lower high. So that means the market on the chart is pushing up, but the market on our oscillator is pushing down. What that means, it means presence of divergence. And if that happens, it means that there is a possibility that this market is going to trade lower. Now, from this point here, there is only one probability that the market will trade lower. Now, note that it's always good to have extra confirmation before you get into such trades. Always have extra confirmation. Why? Because the market may give a tiny pullback and still continue. So for other extra confirmation, this is where you may use a moving average, or you may use a trend line, or pay attention if there is a point of interest or a key area around that area. Also, you may use candlestick patterns. So with this, you can see we have this star pattern here. And this is a very strong reversal kind of pattern. So from here, you can actually go to a lower time frame and look for a sell setup. Also, if you're using the crossover strategy, you can see the crossover at this area. So you see the orange dominating. And therefore, that is a sure sign that we are pushing to the downside for a while. So that is how you can use divergence on the buy cycle. Now, how do you do the same on a selling cycle? So how do you use the stochastic oscillator on a downtrend? So step number 1, identify a downtrend on a higher time frame. Step number 2, wait for loss of momentum. Now, another way of identifying loss of momentum is actually seeing volume to the opposite direction. Like there's a lot of push and pull. Number 3, now look for divergence. Now, here you can see the market on the chart has been creating lower lows. But on our oscillator, the market is creating higher lows. So on the chart, the market is pushing down, but on our stochastic, it's pushing up. Now, that is presence of divergence. Now, this shows that there is probability, very high probability, that the market may shift. There might be a shift from the downtrend to the top. How can you trade this? Number 1, if you're using the crossover, you can see now that the blue line is taking dominance, it is changing. You can also pay attention to the patterns or the candlestick pattern with the crossover, and you can take that trade to the top side. Remember, this is on the higher time frame, so for good entry, for what we call optimal, a dash to your lower time frame and check for the crossover and also the candlestick patterns for the top move. So far, we've discussed how to use the stochastic oscillator by using the crossover strategy. We've talked how to spot divergence using the oscillator. Now we can also add moving average. When you're trading the stochastic oscillator, you can also add the moving average and also the trend line. Now these two are add-ons. When you talk about add-ons, they are for extra confirmation. You want to take trades that are extra confirmed, especially for my risk-averse traders. Also for people who are, you're still growing your account and you do not want to lose that money. It's important that you take trades that are confirmed, okay, for confirmation. We're going to take the same examples as we've used on the crossover and divergence. And now we're going to add the moving average and also the trend line so that we can have that extra confirmed setup. These are trades that are high value. And if you don't know how to take high value trade setups, there is already a video I've done. I think I've done all the videos of everything that you need as a trader. So there's that high value video that you can learn on how to make sure that you do not take trades that are of low probability. You only take high value trade setups. So when using a trend line for extra confirmation, what you want to have on the buying cycle is you want to connect your swing lows. So you want to draw that trend line, connecting these two swing lows, and you only take that after the trend line has been confirmed. There is the break of that trend line. Now with the break of that trend line, it shows that actually the sell move is going to really happen. Okay, so it's extra confirmed. You're not just taking it up here by just using the divergence only. You've waited for that extra confirmation. Now, also, if you're going to use the key area, the key areas, you see these are reversal points. You check this was a sell broken to the top, and this. So you can just draw that key area point there. Okay, and then you see that that's a block. The two tails. The market pushed to the top, you expect it to be retested to the top, but on the second retest, it was broken. So by the break of this key area, again, now it's also extra confirmation that the market is pushing down. And remember, I had already mentioned about the axis. Any point where you have a key area and a trend line moving on the same price point becomes an axis. Now let's add a moving average to that. I've done a video on moving average on how to pick the ones that work well for different purposes. Here I'm just adding a 20 simple moving average. That's very common when it comes to market analysis. And you can see that it's pushing within the key area, touching through the key area, but it's being broken on the same point where our trend line has been broken at. So this means that this is the most safest point where we have our confirmation to the downside. So if you're going to use your trend line, don't make your chart so that you don't need to add all this. You don't need to have all this on one chart. I'm just saying if you need extra confirmation, you have the option of either using the trend line, you have the option of using the reversal point or the key area, this point here where you draw your block on it from. Always look, when you're doing your blocks, always check to the left. Where did the move originate from? You wait for the break, or you can use the moving average. So you pick one. You don't need to use all of them. Or you can use two for extra confirmation you can use. And from this area here, it's safe to say that the move to the downside has been confirmed, and therefore you go to a lower time frame and look for entries to the downside. Now on the other side, on the sell side, step number 1, identify a downtrend or a downward move on a higher time frame. You see that the market has been pushing down, creating lower lows on the chart. But on our oscillator, on our stochastic oscillator, you see the market is creating a higher low instead of a lower low. Now, that presence of divergence is the step number 1 that is very, very important. Now, to join now this move, because the presence of this higher low against the lower low on the chart shows, or is a very high probability indicator that this asset is going to push upward, or an upward move is showing up. So how do you join this upward move? Number 1, you may use the crossover. You can see the dominance of the blue line crossing over from the orange and getting to the tops. Number 2, you may confirm that by using the candlestick pattern. So the crossover and the candlestick patterns is one way. Number 2, for extra confirmation, you may use the trend line, like I've previously explained when using the buy side. So you draw your trend line. Now on the downtrend, of course, you want to touch those swing high. And when your trend line is broken to the top side, now that is extra confirmation that this uptrend or this move to the top is actually confirmed. Now you can see the break has happened with a very big candlestick. That means there was an economic event. So if you had checked on this chart that there's some news showing up, the presence of divergence here and the crossover of this oscillator should have given you an idea of where that economic event is going to push the market towards. So that is also another way that you can use when there is an economic event, by checking divergence on your stochastic oscillator. Now you can also add your moving average. Remember, these are for extra confirmation. So I'm going to add my 20 simple moving average, and it's not special in any way. Feel free to add whichever moving average works best for you. And here you can see that it was broken by the same candlestick to the top side, confirming that our move to the top side is confirmed. Again, for extra confirmation, you may use the key level or the reversal point, the engulfing candle block or the strong block. You can see that it was a sell side, retest to the sell side, then broken to the buy side. This is a strong block. If you've watched the block video series, you've seen that we've talked about the strength of this type of block. And now, being that it's violated by a very big buy candlestick, again, that is extra confirmation to the top side. And therefore, you go to a lower time frame, pick your entry rules based on what you trade. So if you're going to still use the oscillator for trading, go to a lower time frame and check the point where there is crossover. And do not forget to pay attention to the candlestick patterns on the lower time frame. All that I've mentioned is already done on this channel. So all you have to do is make notes, then go back to the channel and watch the specific videos, especially for entry, the candlestick patterns for entry. You can watch the candlestick video for that. So more examples on this. On this example, let me show the importance of having extra confirmation, so that you don't just jump into a trade just by spotting divergence. It's also important to also add that extra confirmation. See here, this asset has been pushing down, creating lower lows. And at this point, it created on the chart, there was presence of lower low. But on the oscillator, on the stochastic oscillator, the market created a higher low. So that means there is presence of divergence. That means that the market is going to push to the top side. But is the market ready to push to the top side from this point here? The market is not ready, and you can see that the market got into some small move but continued lower and created another lower low here. But on the oscillator, there was another higher low. Now, what do you do here? You're supposed to add your trend line. This is where now that extra confirmation is important. Add that trend line. And as it pushes down, you can see that the market continued creating lower lows, created that extra lower low. And on the oscillator, it created that higher low. So the second one here is the one that actually gave that break of the trend line and a retest, and the market was ready. If you don't like using the trend line, you can also add the moving average. Again, I'm going to use my 20 just for overemphasis. It's not any special. I just use it because I feel that it works well with this indicator. So here you can see that this strong move to the top is the one that broke my moving average as confirmation that the market is now ready. Here you can also use candlestick pattern. This is a very strong engulfing candle. So a good candlestick pattern to show that the market is ready. So the chart, the candlestick pattern with the break of the moving average and the break of the trend line is good confirmation that this market will not, accumulate down here and it's ready to push to the top side. So do not just take divergence and crossover and just run with it. Please add that extra confirmation. It's going to help you not to lose when such occurrences happen. Let's get to another example. Now, on this example, I want to show how to take a continuation trade. A continuation trade is where the market had taken a pullback and now it needs to go back to that move, that original dominant move. Now, the market here has been pushing up, so we can say it's on an uptrend, but it got into a pullback situation. And on the pullback, the market has been pushing down. Now, I want you to be very careful with the pullback divergence, because usually it's that type of divergence that we call either hidden, and sometimes it can be very narrow. Narrow meaning it's if you're not a trained eye or if you're not used to it, you may miss it. So if that happens, what you do, the best thing you can do for yourself is actually to change to a line chart. If you struggle with divergence or if you're still learning about divergence, the line chart should be your friend, especially for the pullback. But again, if you train yourself well, you keep learning about it, it's going to be easy for you to spot. So here on the chart, I'll be working on this pullback. You can see the market creating lower lows, but on our oscillator, it's creating a higher low. Now, you do not want to pick these ones that are ranging. No, you want to pick one that has a spike or one that has enough volume where there should be a gap between the two lines. Very, very important. And here we have this low here and this higher low. So that is presence of divergence. Again, do not just take it without extra confirmation. So you want to draw that counter trend line. Remember, counter trend line, different types of trend lines. The trend line that goes against the trend is called the counter. Okay, counter. We are pushing up, but we are going to draw the trend line to the downside. It's countering that trend. So you're going to draw your counter trend line, and by the break of that trend line, now you know that we are done. And this is also one way of trading the pullbacks. There's a video on how to trade pullbacks, and this is one of them by use of counter trend line. Now you can add divergence and the oscillator and you're good to go. So there you have the break of your trend line and you go back to the buying. Also, you can have your moving average. Again, I'm going to add my 20 simple moving average, and you can see the same candlestick that broke our trend is the same price point that has broken our moving average. Again, I'm going to use the key area, the last sell strength, and you see there's the break and the retest, and it's good for the buy. So the note here is to make sure that you have that extra confirmation. That way you do not get yourself trapped or you don't get yourself into a low probability trade setup. So a special note, make sure that divergence is what you spot first every time when you want to trade using the stochastic indicator. Very, very important, because divergence gives it that high value. You get the high probability or high value trade setup if you're going to identify divergence first, then use the crossover, the moving average, the trend line, and the key areas later for extra confirmation. I hope this video has added more knowledge into your knowledge base in Forex trade. I hope you're going to use it in your trading journey. Do not forget to click that subscribe button, click that notification bell so that you'll be notified the next time we do more content. And also share with us on the comment section the topic that would really add value into your trade. Why? Because we want to share information that is impactful. Thank you for being with us. Thank you for the continued support. Remember to follow us on Facebook, Forex Expert Online Academy, and also follow us on LinkedIn. I'm Wanjiru Gisangi. Until the next time, namaste.